Okay, let's get right into it. We're looking at a critical inflection point for the global auto sector. For decades, China was the growth engine for Japanese automakers. Well, that golden era is definitively over. Today, we're analyzing the structural collapse of that position and, more importantly, what it means for the future. Think back just a few years to 2021. This number, 20.6%, that was the commanding market share for Japanese brands in China. This was a fortress built over decades on a reputation for quality and reliability. Honestly, it was the bedrock of their global profitability. And now, that share has been nearly sliced in half. The trajectory is pointing one way, and it's down, fast. We're talking single digits on the horizon. This isn't just a cyclical dip, folks. This is a free fall. And let's be crystal clear about this because it's the most important point. From an investment perspective, what we're witnessing is permanent value destruction. This is not a temporary downturn you can buy into. It's a fundamental reordering of the market, a classic value trap for anyone who doesn't see this seismic shift. So to really understand how we got here and where this is all going, we're going to break it down. First, we'll look at the hard evidence of this unwinding. Then, we'll do an autopsy on why it all fell apart. We'll quantify the financial damage, and finally, we'll look at the high-stakes pivot that's going to separate the survivors from the casualties. All right, let's start with the hard evidence. We're moving past theory here and into confirmed, on-the-ground operational dismantling. And the case study that really sets the tone for this whole thing is Mitsubishi. They're basically the archetype for a complete market exit. Yep, Mitsubishi is the canary in the coal mine. Their complete withdrawal from China, which was formalized in 2025, it just shows you how terrifyingly fast a stable, established business can become insolvent in this environment. And their exit wasn't just a shutdown, it was a fire sale of assets to their competition. And this number, this tells you everything you need to know about the financial logic. The GAC-Mitsubishi joint venture became technically insolvent, with a negative net worth of almost $200 million. Its assets weren't just sold off, they were basically absorbed by a local Chinese EV competitor. Think about that. Japanese capacity is literally being swapped out for Chinese EV capacity. Okay, so we've seen the what. Now let's get into the why. Really understanding the mechanics of this failure is absolutely key to forecasting what happens next, and it really boils down to two things: a massive technological mismatch and just brutal market economics. At its core, this is a classic Nokia moment. Remember them? Japanese automakers perfected the internal combustion engine. They were the kings of build quality. But the market, almost overnight, decided that a premium car had nothing to do with the engine anymore. It was all about the software. And this slide right here just lays it all out. On the left, you've got what Japanese brands were selling, world-class hardware. On the right, you have what the Chinese consumer actually wants, basically a rolling smartphone. This isn't a small gap in product philosophy, it's a chasm. So you've got this product mismatch, right? Now throw that into a total meat grinder of price competition, a phenomenon the market calls involution. You had domestic Chinese brands, led by BYD, starting these absolutely suicidal price wars that Japanese firms with their higher cost structures just couldn't win without hemorrhaging cash. It just completely destroyed their margins. And the result? It's this absolutely stunning realignment of the market. You can see the value transfer happening in real time. Domestic Chinese brands are on track to control nearly 70% of their own market, basically absorbing all the share that the Japanese and, to a lesser extent, the German automakers have been shedding. Okay, let's follow the money. How does this operational failure translate to the balance sheet? Well, this is where a strategic crisis becomes a full-blown financial crisis for some of these iconic companies. Nissan's situation is particularly severe, and it's perfectly epitomized by its flagship Wuhan plant. This place was supposed to be a crown jewel, churning out the Aria EV. Instead, it's become a poster child for massive capital misallocation and is now slated for closure. And this is why. Just look at this number. The plant has been running at a catastrophic 3% utilization rate. In a high fixed cost business like auto manufacturing, a number like that is simply unsustainable. It's a factory-sized cash incinerator. So that operational disaster leads directly to this, a forecasted net loss of up to $5.3 billion for Nissan's fiscal year. And get this, that loss is almost entirely driven by writing down the value of these now stranded assets in China. As you'd expect, the credit markets have lost all confidence. Fitch has now pushed Nissan's debt into junk territory. This is a huge deal. It dramatically increases their cost of capital, and it creates this vicious doom loop where it becomes too expensive to fund the R&D you need to actually escape the crisis. But, it's not all doom and gloom. Out of the ashes of this collapse, a new strategy is emerging. The capital isn't just being written off, it's being reallocated in a massive strategic pivot away from China. I mean, this chart just says it all, doesn't it? Japanese foreign direct investment into China, it's collapsed by 83%. At the same time, investment into India has surged by 700%. This isn't a subtle shift, it's a decisive, hard pivot. And we are not talking about small change here. The scale of this bet is immense. We're talking about a cumulative planned investment of over $11 billion by Japanese automakers into India. This isn't a hedge, this is a full-blown strategic effort to build a new primary growth engine from the ground up. So, the crucial point is that this isn't just a retreat, it's a strategic redeployment. The game plan is to build a new growth engine in India, which, by the way, looks a lot like China did 20 years ago and is protected from Chinese competition by tariffs, while also building a defensive moat around their legacy strongholds in Southeast Asia. So finally, let's put it all together and project forward to 2026. What does this new world order look like for the auto industry? Because the global map is literally being redrawn into two very distinct spheres of influence. This dashboard really summarizes our 2026 outlook. In China, Japanese brands become niche players, if that. Toyota, with its fortress balance sheet, weathers the storm and becomes a stable yield play. Honda's outlook is negative as it struggles. And Nissan remains a distressed asset, handicapped by that junk credit rating and locked in a desperate battle to restructure. And all of this leaves us with one final massive question. As the global auto world splits in two, the scale you need to compete in software and EVs is just immense. So for the struggling players like Nissan and Honda, is a forced consolidation, a merger, no longer just an option, but an absolute, desperate necessity for survival?